Hey everyone, welcome in this YouTube channel. Here's my first video, so I'm quite excited. Today I'd like to show you how to build from scratch an LBO model on Excel. So we're going to model our assumption, input and recap section, then we go through our sources and uses, then we'll see our business plan drivers. Then we'll model the income statement and the cash flow statement. Then we will see the academic schedule, and at the end we run some sensitivity tables, sensitivity analysis, and we'll see the return analysis of this model. So this is what the final model will look like, and we'll have a look also at the overview of the transaction, so how an LBO transaction works on a accounting basis. For simplicity, this is the model empty. I'm just keeping the formatting because otherwise it's taken too much to make the model. So, okay, let's start with the good trade price we are going to pay for buying the target. Okay, I'm gonna give you two different ways to define the trade price. The first one is generally used for company that are not publicly traded on the market, it's for private companies. This is instead the second way to define the trade price for company publicly traded. Okay, so let's suppose that our EBITDA for the 2023 is 50.3 million, and our EBITDA entry multiple is 10, which gives us an EBIT of. We are supposing that our target company doesn't have financial debt, so it has a net financial position of 0, which gives us an equity value of 559 million. We're going to acquire the 100% of the company, which gives us an equity value of 509. The second way you can do purchase price is based on the current share price of the company. You can find it, for instance, on the finance. Let's suppose that we have a current share price of, for our premium price, because obviously the share price, the current share price of the company, it expresses the price, the price of the share from a minority perspective. So if you want to buy your company, you're going to pay a price over the potential price. So that is 15%, and our share outstanding is 125 million, which gives us an equity value of transaction. Okay, let's assume million. That we're gonna be amortized over 5 years. Okay. Okay, so those are all of our assumptions and inputs. Okay, if you have any questions, please leave a comment below. Okay, so let's now, okay, always keep in mind that our sources and uses have to be equal. So the total sources must be equal to the total of uses. Let's start with that here. So we have what the term loan and the volume. So that is the sum of this term. Mm, okay. Okay. Remember that the equity you need to buy the company is calculated by this sense. Just give me a moment and I'll show you why. Okay, so about the workplace price, before, right? Um, okay, here I'd like to make this cell didn't choose. Okay, I'm gonna show you how this works and how to make a choose. Responsibility. So you have to and like to automatize the way you can choose the purchase price, which means that I would like to throw out a button here and would like to pick the equity value computed throughout the first method or the equity value calculated with the second method. Right, to do that, you have to go developer, insert, form controls, and then this, then go right click, format control, right over there, for instance, and control and current price. Okay, let's color them this little gray. Then we go over there, plus use, use, right, click here, not bad. Go to input range, select this cell, then about the cell link, I recommend you to link the cell beneath the button, which is on 32. Okay, I click over there, I have my data multiple and venture type. Then plus use index number this one. Then we're going to link this as the first one and second one, this one as the second one. Okay. If I go down to the multiple, it gives me this one. Just to balance sheet is 0. About the transaction fee, we said that mm, uh, cancel and transaction. Yeah. This one plus some. Okay. Settled it before. equity is computed as the difference between this and the dividend. Okay, that's it. Oh, save. Save. Okay, perfect. Just so you can see balance perfectly. Exactly the equity we need to buy the company and the equity we have put in our sources and uses tab with the cash of, I mean, if equity fund creates the SPP with equity and injecting cash. In the second step, the SPV collect from banks financial debt in order to acquire the target. We are gonna have that we have model here. Okay, so click on one, and obviously our cash goes will go up by the liquidity increase of financial debt. In the third step, our SPV is going to buy the target. So with the record and the every intersection won't change, but we're gonna use the cash we have on our asset on the asset side for buying our target. So here our investment target is equal, okay? And then this is balance sheet. This is obviously a device balance sheet from our target. So it will have assets, current and fixed asset equal to section 12 million, and would be an equity equal to 4.5, so 105.50 from its accounting book. Then the last step, if we take the SPV and target map, so we're going to have something like that. We're going to have the equity from the SPV. That will be equal to the sum of the debt on the SPV and that on the target, but we have assumed that our target doesn't have any debt. And we're going to add on the asset side the assets from the target, and the goodwill will be equal to the difference between our investment the SPV made, the price the SPV paid the buying target, and the equity book value in the target. You can see our asset and liability perfectly balanced. Okay, so let's go defining um, our inputs, our derived from our income statement and cash flow statement. Okay, so according to I start probably with inserting our actual data, which means that our target company has actual data, the revenues equal to provide 4.7, maybe I'm not all the student the other, then we have 8.2, time, it took a while, then LS engineering, which stands for selling general and administrative expenses equal to 1.7. Our EBITDA will be the sum of two. We're gonna have DNA about Okay, so we have also the motivation of financing and transaction fees. Obviously, the motivation of financing and transaction fee will start in the after the acquisition, because this is the income statement of the target acquisition. About interest expense, we have said that the target has no debt, so it will be equal to 0. Okay. And our heading will be this one plus this one. Yeah. According to the taxes, okay. Taxes, okay. Let's say from the US. You can check them